Now, despite the rise in the stock market today, the threat of new tariffs is still very real, and that could create a bigger headache for some of the key sectors of the U.S. economy. So tonight, we're going to look at the potential impact on three of those sectors: retail, autos, and technology. We begin with the retail sector, which has a lot of exposure to the world's second largest economy. Here's Courtney Reagan.
Much of the focus of this quarter's retail reports has been the impact of tariffs on goods made in China. Companies from Home Depot to Kohl's have talked about strategies to mitigate the higher costs from tariffs. While no retailer is so far in favor of the tariffs, most are figuring out how to lessen the impact so that profit is protected for investors and prices are stable for shoppers. But that was when tariffs ranged from 10 to 25%. Now they're 15 to 30%. And President Trump told U.S. companies to pull production out of China altogether. The National Retail Federation said, quote, "It's impossible for businesses to plan for the future in this type of environment. The administration's approach clearly isn't working. The answer isn't more taxes on American businesses and consumers. Where does this end?" Footwear Distributors and Retailers of America said there is zero doubt shoe prices will rise, hurting poor families the most. This uncertainty may directly plunge us into a recession where we shed thousands of American footwear jobs. Quote, "The United States has created record expansion built on a confident and empowered consumer. A protracted and costly trade war is the one thing that can shatter consumer confidence and ground this economic high." That from the Retail Industry Leaders Association. Even as retail has moved manufacturing out of China over the past decade, more U.S. sold shoes and clothes are still made there than anywhere else. Prior to Friday's escalation, Nordstrom CFO had said the tariff impact would be, quote, "relatively immaterial," and Urban Outfitters CEO said he is, quote, "reasonably confident that the effect will not be too great." Macy's CEO said he was working on solutions to manage a 10% tariff on merchandise, including clothing and shoes, without raising prices. But if that goes up to 25%, the path is unknown. It's not clear what the plan is now for Macy's and other retailers. For Nightly Business Report, I'm Courtney Reagan.
For the U.S. auto industry, China represents its largest market in the world, which is why a resolution to the trade war with China would bring a sense of stability and clarity to that sector. Phil LeBeau has more.
The car business in China is slowing down, and you can see it in showrooms. In fact, as that country's economy has pulled back, auto sales that surged over the last 2 decades have fallen for 13 straight months. That's hurt automakers like GM, which has several plants in China and sold 3.6 million vehicles there last year. Last quarter, its China profits fell by more than 50%. Now, with President Trump and China's President Xi threatening to raise tariffs again, automakers are preparing for the fallout. Take Tesla. One report out of China says the automaker will raise prices later this week in response to China once again lifting tariffs on American-made cars. Tesla will be able to avoid those tariffs when it starts building the Model 3 in China. CEO Elon Musk broke ground on Tesla's new Shanghai plant earlier this year and says it should be up and running in a few months. Meanwhile, SUVs from BMW and Mercedes built in the southeastern U.S. and shipped to China would also be hit by higher tariffs. The uncertainty that swirls around the China auto market shows no sign of slowing down, especially with the U.S.-China trade war flaring up again, meaning an industry that was counting on China to rev up profits has shifted gears and must accept slower growth in the future. Phil LeBeau, Nightly Business Report, Chicago.
And then there's the technology industry, arguably one of the most influential sectors in the markets because of its weighting in the S&P 500. Josh Lipton looks at the potential fallout.
Many tech companies count on China as an important market and key part of their supply chains. Take the semiconductor industry. It does a lot of business in China. According to one estimate, there are some companies in that sector generating more than half of their revenue in that country. And don't forget Apple. China represents an estimated 12% of its sales. It's also where the company assembles many of its products, like iPhones and iPads. And there's a big date coming up for Apple too, September 1st. That's when its wearables like the watch and AirPods could get hit with a 15% tariff. Given these trade tensions, some analysts think a smart bet for tech investors could be to stick with those companies that don't have exposure to China.
Our two top picks, Netflix and Facebook, have zero exposure to China. So we like these stocks. We don't think they'll be impacted by trade tensions.
And there's one thing most experts agree on, that the increase in uncertainty is making it even trickier to navigate this critical sector. For Nightly Business Report, I'm Josh Lipton, San Francisco.